look at these, we looked at Lyft and said, you know what, this sets the tone for the IPO market. Lyft hasn't been doing well. Right. We're getting two other high profiles. What should we expect here?
Well, I think you look at the two that are going today, they have a lot more public comparables to benchmark against. Where Lyft is doing something very different. They're the first company in that sector, in that space, going public, doing amazing things, changing a lot of different parts of the environment they're in. So I think you have the market looks for benchmarks. And this makes a Zoom comparable, I think, to, as you mentioned earlier, Okta, Zscaler, even the class 2016 with the Nutanix, Coupa. There's a lot of good benchmarks, and Zoom is obviously has some pretty amazing metrics.
I mean, it sounds like the message to the average investor, or to any investor out there, then is, you know, when a company is truly disruptive and in an industry that may be labeled as a new one, we don't really know what the valuation is for a while.
I think that's right. I think you have to look at time frames. You have to look at what your investor horizon is and what you're thinking about that company may or may not do over the long term. I can tell you, Lyft win the IPO process, we're not thinking about how do I, you know, have a great first month, and that's why I'm raising $2 billion. They're thinking about how they're going to change the world and do things over years. So I think we get a lot of us in the press everywhere. We think a lot about the short term versus the long term.
So let me ask you a different question then. The investor profile for somebody investing in Lyft relative to somebody investing in Pinterest or Zoom, do you think they're totally different? Should be different? I'm saying if you're a retail investor and you're watching right now.
Well, look, retail investors owning individual stocks and having it be a large part of the portfolio is not the norm by any stretch. So usually if you go a retail investor into a stock like a new IPO, they're going to have to be a very small percent of their portfolio.
Well, let's say you're an institutional investor,
a
a mutual fund manager of a growth fund, for instance, and you're taking a look at this crop of, I mean, all of these could qualify as growth companies. Are you feeling burned from Lyft at all? Are you feeling cautious because of the way Lyft traded?
I think, again, you need to think about the time horizon, right? If you look at how many IPOs that we talked out in California, pricing for perfection, a company wants to maximize the amount of money they raise. They want to give something to investors. That does not happen in a magical formula. It's an art.
Do you look, though, at the Lyft IPO and think that there were mistakes made? And let me just say where I could posit, at least, that the critics would say there were mistakes made. They could argue that the underwriters, including J.P. Morgan, were allocating stock to people who were prepared to sell it on day one. We had Keith Meister on our set right here, literally 48 hours after, say, I bought because I was looking at capital flows, not because I was looking at the company. And yes, I sold effectively on the first day. So, A, is that a problem? B, there is a view that when you open that book that you might have wanted to wait. This is on the Nasdaq. Maybe should have waited an hour, let things settle out a little bit because there was a little bit, maybe too much excitement at the very tippy top in the beginning. I mean, when you do a post-mortem on these things, how do you look at it? And I think it's impossible to say it worked brilliantly because I think we're standing here having these questions.
I'm not going to comment about Lyft specifically, but if you look at the amount of IPOs that price below their offering size, about 25%. Okay, you look at how many price above the range, about 15%. Most are in that middle spot somewhere. Our part of the process is really to open the stock when the underwriter says to open the stock. So they're in control of that process. A lot of companies go through volatility. I think the press will report, obviously, on the ones that do things that keep going up and up. But there's a lot of companies don't perform from a stock price perspective right out of the gates.
Right. What do you know about short interest? Because that became also a big topic and debate within the context of the Lyft IPO, which is to say that within the provisions for early investors at the IPO on Lyft, that they were technically not supposed to be able to short the stock. Then you had allegations that Morgan Stanley was coming in and creating problems and trying to sell some kind of instrument that would allow these investors to do that. What do you know about that, and how are you thinking about that relative to these next generation of IPOs?
There's two topics in there, and I'll mention them broadly. Every IPO today, in most cases, has a lockup provision that's negotiated between the underwriter and the company, and that's something that has been around for a long period of time. Stocks can be shorted after a company goes public. Short sales are not disclosed. 13Fs are disclosed. Long buyers, we have been advocating at Nasdaq to disclose short sell interest. So at this point, not a lot's known about in terms of who might have been shorting, and probably wouldn't be known for a long period of time. But trades are marked short, but it's more on the broker deal level.
And how do you feel, though, about the underwriter community, which is also in the trading community, offering these kind of swap products at the open?
I think all this is pretty early days. in terms of the investigation. I think if you look at, or not the investigation, but the topic, I think lockups are being discussed right now, though, quite a bit.
More broadly, though, I mean, you take a look at the IPO market and you think, oh, there's so much optimism and excitement over these unicorns going public. That's great for market sentiment. Yeah. That means if you believe that, the reverse can be true, that if they don't trade well, that could dampen market sentiment. So how important is Pinterest and Zoom going to be to sort of not erase, but overshadow what's gone on with Lyft?
As you can imagine, I watch CNBC most of my days when I'm in my office, and there's been more talk about Zoom and Pinterest than I've ever seen you talk about IPOs. So there's a lot of attention on these two deals, but at the end of the day, we're going to probably have Nasdaq alone have over 90 IPOs in the first half of the year. Okay, so a deal or two deals the market does not make, but they certainly have an impact. And I think you have to compare them to how the other ones that are going to follow them, their comparables, will be doing. So the next wave of enterprise deals, you know, how well Zoom does, there's a gauge there, but they're not going to impact, Pinterest does not impact those. If that makes sense.
What do you think these deals mean for, or what do they say about the viability of the private markets? You see Pinterest coming out, even though they're pricing above the range, it's still a level below their latest private round 2 years ago. Sure. With Lyft right now in the public markets, it's trading pretty close to the value it was in the private markets. I mean, are we seeing some sort of disconnect that could kind of shake up the viability of the private markets as it relates to these companies looking to go public?
I don't think so. I think you know fairly well, I'm sure the audience does, that the valuations you hear about the private marketplace are not always a like for like, because there's different types of class of shares in the private marketplace.
Right.
So I think we're seeing a very vibrant private market. We won the Nasdaq private market. We're seeing all-time records of how many transactions are going through that platform. So the private market is still very active. I don't think a deal or two changes that. And again, the private market valuation that's in you kind of read about is not always a valuation on a comparable basis because of the share classes.